Yo, what's going on, guys? Bexio back, and today we'll be talking about investing and how you can start investing in the simplest way possible and different types of ways to go about it. Everyone thinks investing could be super hard. You gotta put a bunch of time into it, know the companies, everything else, which could be a component to investing, but doesn't have to be everybody's strategy and everyone going into investing. There's other ways to go about it. And the way I'm going to talk about in this video is using index funds or ETFs to invest in and just passively invest and not have to actively manage your portfolio or manage any stocks you're in. If companies are doing good or bad, you can just invest in these index funds and these ETFs, which are basically broad market funds that anyone can invest in. So basically what an index fund is just like we said, a broad market fund, something that covers a large market, something like the entire US market, US equities market. There's funds for that. The S&P 500, there's international markets, markets that follow a bonds market, markets that follow gold. There's a market for almost everything, but we're going to focus on a couple different ETFs, index funds that you could look into starting to buy or continue to buy in, and this could be your strategy because they follow the market. So the first one that we could look at is VTI, which is the Vanguard Total Stock Market Index. This one follows the entire US equities market, meaning that there's every company, US company that's traded publicly is going to be involved in this ETF. I think there's about 3,000 companies involved in VTI. So that means when you buy a share of VTI, right now it's at like $163, $162, somewhere around there. And when you buy one share of that, that money gets dispersed about 3,000 different companies. So you're instantly diversified and you're instantly involved in the markets. And you have shares like Apple, Microsoft, Tesla, McDonald's, all those companies you're going to be involved in because it tracks them. They're involved in their portfolio. But you're not going to have to go out and buy individual shares of those companies. Now I can pull up VTI right here and we can see that the stats about VTI is how it says in Robinhood here, but you can basically see the dividend that it does pay, dividend of 1.78, meaning that you're going to get paid for holding these shares. And the good thing about that dividend is it's pretty much going to pay. It's definitely going to pay for your expense ratio because VTI being an index fund, all index funds have expense ratios, but VTI's expense ratio is somewhere around like 0.03%, meaning for every $10,000 you're going to be paying a expense ratio, you're going to be paying $3 for them to manage that money within the index fund, which also being paid a 1.78% dividend obviously is more than 0.03%, meaning your dividend will completely cover the expense ratio as well as give you money for holding the shares of VTI. And the next index fund I'm going to talk about here is the Vanguard S&P 500 Index Fund or ETF. This is ticker symbol VOO, and this tracks the S&P 500, so the top 500 companies in the United States. And this basically means that you are going to be invested in those 500 companies by buying one share of VOO and diversifying your money again at the same time, as well as giving you those companies that are very expensive like Apple and Amazon, Tesla, where one share could cost quite a bit, but now you can be involved in all of them with just paying for a VOO share, which you can do fractional shares and things like that, but VOO covers everything here. It's just like VTI, just like every other Vanguard, obviously. Has a dividend of 1.81% and an expense ratio of 0.03%, so it is identical to VTI, meaning obviously $10,000 will be $3 cost for the management, but your dividend will cover those $3 or 0.03%. So those are the two big index funds that I look at, and I'm involved in VTI and could be in VOO shortly, but I do have VTI shares and money in there. But there are many index funds that you can choose from. There's many different types of ETFs you can choose from. There's, the SPY ETF, another S&P 500 type thing, as well as many other VTI index funds measuring like dividend growth, growth index funds, bonds index funds. There's everything you could imagine. And if you're interested in passively investing, meaning you don't want to manage your portfolio, buy 30 companies and have to manage all 30 on a daily basis to make sure that nothing's going wrong with any of those companies, then buying an index fund does it all for you for a super cheap price and basically free because of how the dividend works. So you can jump into an index fund, VTI, VOO. Any Vanguard fund is highly respected and thought of as a pretty safe index fund where they're not going to mismanage any money and things like that. You can trust them. They've been around and they've been continuing to do good work, and everybody just trusts them. So they're a big index fund too, with almost like in them. But VOO, VTI, very similar. Vanguard are going to be very similar and respected. And you can venture out into other ones like SPY. They have their whole things. I think Kevin O'Leary has power shares, like his thing, his management ETF funds. But an ETF is super easy to put your money in and let it grow as long as you're willing to let it sit there and do its thing, and not have to pull it out at some times and get worried some or anything like that. So if you don't want to actively manage different companies, then your best bet is to go into index funds, and it's a great place to start. As well, the only thing people might think is a downside is investing in individual companies can yield a much higher return, but obviously if you have the time to do that, then you're going to want to be doing that. But if you don't have either the time or knowledge or want to actually go about like learning how all this stuff works, then index funds can be your best friend and still grow your money at great rates. I think even with the illness drop in prices that we've recovered from pretty well on all markets, they're still averaging for the last 5 years a 10% return a year, which is really good. So it's a good place to put your money, and if you don't want to do individual companies or you're just starting, give it a shot. Let me know what you guys think of index funds, if you use them yourselves or if you're just interested in solo companies by themselves. And as always, guys, don't forget to comment, rate, subscribe. Also on Twitter. I'll see you guys in my next